everybody. My name is Brent Johnson, and I've got a firm called Santiago Capital. I'm based out of San Francisco. I've been in the wealth management business for about 20 years. And one of the things I'm going to talk to you about today is, well, I'm going to end up talking about a couple of my favorite subjects, which are dollar and gold. But I'm also going to talk to you about this theory that I have called the dollar milkshake theory and how that plays into the Canadian economy as a whole. Now, one of the things that I'm going to do as I talk about this is how debt plays into all of this, because global debts have really grown. Total global credit's around $200 trillion, and debt to GDP on a global basis is around 250%. So, it has a huge role in everything that we do. And I hope that regardless of whether you agree with what I say later or not, that we can agree that the debts have gotten to a level that are completely out of control and are going to have severe implications for the world as a whole. Can I get a show of hands for people that are concerned about the debt levels? Okay, good. So I don't want to speak for anybody else, but I think most people that come into the gold world do so once they realize that the monetary system, the way it's designed, leads to these runaway debts. They're never going to be able to be paid back. The central bankers are going to have to print currency until it's worthless, and as a result, the dollar is going to lose value. And since it's the global reserve currency, gold's going to go through the roof, and everybody needs to own gold. Is that a fair assessment? Anybody ever heard that argument? Okay. So it may not surprise you to learn that I do agree with that to a certain extent, but maybe not in exactly the way you think, because while I definitely think the monetary system is going to die and it's going to have to change, I think it's going to do so because of dollar strength and not because of dollar weakness. And part of the reason that I think that is because, well, first of all, let me go. I'm not going to be able to go completely into the dollar milkshake theory here because I just don't have time. But if you Google it, there's plenty of material. You can also see the presentation I gave here last year, which describes it in more theory. But to give you a quick overview, the way I explain it is after the global financial crisis, the central banks of the world took out their monetary syringes and they injected the world full of capital. They printed yen, they printed euros, they printed yuan, dollars, pounds, and they mixed this, what I like to call this big currency milkshake. And so, that went on for a while, but at the end of 2015, the Fed stopped helping the rest of the world. They stopped injecting. They no longer were providing stimulus to the economy. And in fact, what they did was they swapped out their syringe for a straw. And what that does is that allows them to suck all the capital that's still being mixed from around the world and the other central banks into the American markets. And that enabled the U.S. to start drinking the rest of the world's milkshake, as I like to say. And this can be explained, if you ever saw the movie There Will Be Blood, it's a movie about this oil baron named Daniel Plainview, and he explains to one of his competitors here that it doesn't really matter if Eli has oil on his land, because all Daniel has to do is stick a straw in over the fence and he can drink his milkshake. So that's kind of where the thought comes from. Long story short, I think we're headed for a global currency crisis. And for a number of reasons, I think the dollar is going to drink the milkshake that the rest of the central banks are still mixing. And over the next few years, this dollar straw, along with the institutional effects of having the global reserve currency, is going to allow the U.S. dollar and U.S. dollar-denominated assets to get big and fat. Now, here's a chart of the dollar going back to its all-time high in the mid-'80s. And as you can see, it's kind of nearing the end of this long wedge. And I think as we move into this currency crisis, I think it's going to break out to the upside. And I think we're going to have what's going to be a perfect dollar storm. Because when I say that we're going to go higher, I don't mean a little bit higher. I think we're going to go back to the all-time highs of the 1980s. And part of the reason that when that happens, I think that the U.S. is going to have inflationary pressures from these capital flows coming in. And I think those flows are going to let us continue to finance our over-leveraged economy while the rest of the world is starved of liquidity, and they're going to have a hard time functioning as their over-leveraged economies don't get enough flow to allow them to operate. Now, part of the reason that I say this is that because while the U.S. has an enormous amount of debt, the rest of the world does too. And what this chart here shows is the rest of the world doesn't only have the debt in their own currencies, they've got over 12 trillion of debt in US dollars. This is dollar-denominated debt that they have to service in dollars. So this debt is actually demand for dollars. And as the dollar gets higher, that demand becomes even harder to satisfy. So if you have a high demand with a lower supply, that's usually a price or formula for price to rise. Now, two of the biggest dollar-denominated debt issuers over the last 10 years have been Turkey and Argentina. And if you want a preview of what I think is going to happen to some of the other countries, just take a look at what's happened to these two countries over the last 2 years. Their currency markets have been cut in half, and their stock markets have been cut in half. And that's with the dollar hasn't even broken out yet. And this is with interest rates still at all-time lows. I mean, there's still $12 trillion of negative interest rate debt out there. So if you're going to have trouble functioning on an economy when you've got ultra-low rates and global growth is still somewhat positive, what happens when the dollar gets higher or global growth slows? Now, how does this affect Canada? Well, the good news for Canada is you have a world-class flag. I put it in the top 5 flags of all flags. I think it's just beautiful. It's simple, it's strong, it's red, I love it. But you know, the best thing that I think that Canada has going for it is that it's located right next to what I think is going to continue to be the strongest economy. And I'm not trying to be the ugly American to come out here and says, we're the greatest thing in the world and the rest of the world is trash. I just happen to think that right now we have the strongest economy. And I think that will be a benefit to Canada, even if there's some headwinds elsewhere. The other good news about Canada is on the surface, it looks like it has a very diversified economy. There's over 30 different industries that contribute to GDP. The problem is that when you actually dig below the surface a little bit, only 3 industries account for over 30% of GDP. And that's real estate, construction, and commodities, or natural resources. And all 3 of those industries are extremely leveraged. And I'll get to that in a little bit more in just a minute. But another issue that Canada has is their second biggest customer is China. Now again, there's nothing wrong with having China as a customer. That's a big market. The problem is they're leveraged. And so either your first or your second biggest customer is over leveraged. If they go into a downturn and they have trouble, what does that do for the demand for the commodities that come out of Canada? I think it's a real problem. So let's go back to Canada for a second in the real estate market. Now, it's largely avoided a downturn after the global financial crisis due to the government's mortgage purchase program. And devoid of moral hazard and the chance to lose any money, real estate's gone from primarily being shelter to a place that you can make tax-free gains and some quick profits. And as a result, Canada's household GDP, or debt to GDP, is up to 70%, which you can see on the left graph. And its mortgage debt is almost 50% higher than the corresponding figure in the United States. You can see that on the right side. So, and I think Vancouver has the second most expensive housing market in the world next to Hong Kong. So all this has led to household debt to income for Canadian citizens to be at 180%. Long story short is that Canada's credit fundamentals rank among the worst in the entire world, both developed and undeveloped. In other words, the Canadian citizens are highly, highly leveraged. Remember those people that put their hands up earlier about worrying about leverage? It's right here in Canada. So what about the Canadian banking system? Again, on the surface, it appears to be fairly conservative. But when you drill down and look at their credit risk exposure, we see that 84% of the risk-weighted assets are exposed to credit markets. This is from a combination of both lending and investment portfolios. Now, this has been growing over the last 10 years, and while it's not quite as high as it was back in the 80s, you got to remember that in the 80s, interest rates were much higher, and there was a lot more room for the Bank of Canada to cut to counteract any downturns. They don't really have that ability today, or at least not to the same extent as they did back then. Now again, if you look at debt coverage ratios, they actually look pretty good. Various loan coverage ratios don't show anything to really be concerned about. However, credit spreads have never been closer or tighter, and rates have never been lower. As a result, the primary risk exposure to the banks is rising interest rates. For example, and you don't have to look too far back in the global financial crisis, how quickly these things can change. From 2007 to the beginning of 2009, this ratio more than doubled, which means the coverage ratios deteriorated extremely quickly. And that, again, was with rates much higher than they are now. Bottom line, while the banks appear to be conservative, once you peel back the onion a little bit, they lend to a real estate market that's the most expensive in the world and is severely leveraged, and a population whose credit fundamentals rank among the worst in the world. In other words, the banking system is itself highly leveraged and at the mercy of an economic downturn or higher rates. Okay, so as noted earlier, mining and energy extraction is another one of the key industries for Canada. Next to Saudi Arabia and Venezuela, Canada has the third largest reserves of crude oil on the planet and is in the top 5 producers of natural gas. I think everyone here understands that Canada is a very binary economy. You've got the commodities and the resources in Western Canada, while on the East Coast or in the Eastern Canada, it's dominated by real estate and finance. But that doesn't mean that this industry on its own isn't very important to the Canadian economy as a whole. All you have to do is look at the Western Canadian oil price versus Canadian GDP. But what I find interesting is in the last year, you've started to see this divergence where GDP has started to pick up a little bit, even though the price of oil has remained flat and even turned back down a little bit. I point this out because it's absolutely crucial for the Canadian economy for oil to continue higher. Because if it doesn't, we've got a real problem. Because the debt maturity profile for the oil and gas industry as a whole sees hundreds of billions of dollars of loans that must be refinanced over the next 5 years. If energy stays high and rates remain low, these will get refinanced. But if either one happens, if oil price falls or interest rates rise due to some credit event, there's real problems because the entire industry is extremely, extremely leveraged. And it's all dependent upon the ability to maintain that leverage. It doesn't get much that better when you drill down into the mining side of things. They too have a debt maturity profile that is not to be ignored. Once again, over the next 5 years, hundreds of billions of dollars need to be refinanced. Again, if commodity prices stay high and the leverage rates stay low, this probably gets done. But if either one of those changes, this can go south very quickly. Now this picture shows what happens when you drill down into the precious metals industry specifically. Now, prior to the global financial crisis, the debt-to-equity ratio of gold mining companies and silver mining companies was approximately 1-to-1 or 50-50. But over the last 10 years, the executives at these companies have tapped the debt markets 10-to-1 versus equity when raising new capital. In fact, the point is that while, over the last couple of years, some of these companies have started to pay down their debt, they still have debt that needs to be repaid. You can see that maturity profile right here. Again, as everybody in this room knows, gold has made a heck of a move, and it's, if gold keeps up at these levels, they're not going to have any trouble refinancing this. But they're not going to be able to do it at the same rates that they did, or if rates go higher for whatever reason, it makes it more difficult to be done. And if the price of gold happens to go back down, it becomes much, much more difficult. Again, just the point I want to point out is that many people own gold because it's a insurance policy against the system. But if you own gold mining stocks, just make sure you know what you own because your gold may very well be leveraged. So far we've just talked about the industries and the citizens, but let's talk about the federal government and the provincial government as well. Because the federal debt has almost doubled from $450 trillion to $750 trillion over the last 10 years. But that kind of hides the real big problem. The real big problem is in the provinces. Provincial debt is now bigger than federal debt. So if you add the two together, you've got about $1.5 trillion. And if anybody thinks that the federal government is just going to let the states go bankrupt, I have a hard time believing that happens. Almost every province has dramatically increased their debt levels over the last 10 years. Ontario is by far the biggest one on a gross basis, but on a net basis, Alberta went from having a budget surplus to a negative deficit. Even the least egregious borrower increased their debt by 25%. So it's across the board. This is not an isolated event. And it's gotten to the point where, that's what I said, the provincial debt is now bigger than the federal debt. And it's important for a few reasons, and I'll address why that is in just a second. But first of all, I'll say the governments are never going to tell you this is a problem. In fact, they'll tell you this is all very well under control. Their best and their brightest have looked into this, and they assure us that it's very manageable. And over the next 40 years, they expect the debt-to-equity ratio to not go up, but actually fall down to less than 10%. Well, let me tell you how they do that. This is their projections for what they assume interest rates are going to do over the next 50 to 60 years. I mean, if you've been looking for the most ridiculous chart of the week, this is it. To assume that interest rates are going to maybe rise 1% over the next couple of years and then stay there for 50 years is about the stupidest thing I've ever seen in my life. Part of the problem is that provincial debt, when it's bought, it's often held to maturity or sold once in a while. In other words, it's bought and not sold. and certainly not sold at the same time. If Canada goes into a downturn and the holders of these decide they need liquidity, and this is where they look for it, the problem is that the provincial market is now as big as the federal market. But the most liquid provincial bond is only 20% as liquid as the federal government debt. So if you get a bunch of sellers that need to sell in a very illiquid market, it gets to be chaos rather quickly. So I think this has, so going back to, as I said, I think the dollar gets much stronger. And when that happens, I think it puts downward pressure on the rest of the world. And I think that has the opportunity to cause credit rates to spike for those countries outside the United States. Not because things are getting better and interest rates are picking up because of inflation, but because of the credit risk associated with it. Canada's top 3 industries, their top trading partners, their citizens, their banking system, and their provinces are all leveraged to the hilt. So if you were one of those people that raised your hands earlier and you live in Canada, you should be very, very worried. Sorry to say. Because the signs are all there. Why should you avoid the Canadian or fade the Canadian jobs? Why are trade grinds to Canada's economy to a halt, or Canada housing sales fall? These are all recent headlines from either recent reports or newspaper articles or magazine articles. And as Bank of Canada Governor Pelosi himself said, Canada is not an island that is disconnected from the global economy. If the global economy does not keep up, Canada is not going to be immune to the effects of it. Now, that doesn't mean that the Bank of Canada won't try. They definitely will. We think their first move will be to cut rates and abandon their hawkish monetary policy. We think they'll be forced to cut rates, and maybe even aggressively so. We think that this will be negative for the Canadian dollar. And as this currency crisis develops, we think the Canadian dollar will fall significantly, maybe back to its as this chart rises, that's the Canadian dollar losing purchasing power versus the dollar. And as the U.S. dollar gets stronger, again, we think that this has pressure on global economy, and it could cause sovereign yields to double, not on inflationary concerns, but on credit concerns. And that will have a hard impact on Canada. And so Canada is smack in the middle of this currency crisis that I see coming. And it's for these reasons that I think if you're a Canadian dollar investor, the 2 most important assets that you can own are dollars and gold. Because the opportunity to make money by playing fiat currencies against each other has never been greater. It's enormous. The trades that are available now with interest rates at their all-time low and currency volatility at their all-time low are absolutely enormous. So if you want to talk about how to do that, let me know. But also you should have physical gold, because when this is all said and done and the monetary system gets reset, gold's going to be the last man standing. And with that, I wish you all the best of luck.